Hey, welcome back. Today, even after going down a bit recently, gold is still at some of the highest levels in history. Gold miners, on the other hand, are at some of the lowest levels in more than 5 years. We can see, for example, Barrick, Newmont and some others at the same levels as in 2019, which is, in most cases, half of the price from a year ago. 5 years ago, however, gold was below 1,300 per ounce, which is 30% lower than today. We already know that, unlike with any other metal, investing represents a big factor for the demand of gold, and there is something we have to consider. One important aspect that may have a positive impact on the demand for gold is the interest rate. Right now you can keep your money in the bank or in treasuries and get like 5-7% per year, while gold is technically not giving you any return. But in a couple of years, when the Fed is going to reduce the interest rate and these yields become 2-3%, gold becomes a much more attractive option. Not only that, but a lower interest rate would also be good for the miners, as it would allow them to invest more at a lower cost. So with these things in mind, I think it's a very good idea to take a look into gold mining companies and at least be ready in case the prices fall even more. Before we get into the companies, I want to mention something. We have to remember that the thing with almost any miner out there is that the price of gold is going to be the key to their long-term performance. If gold is getting from 1,800 to 3,000 for example, they are all going to be multi-baggers. Some will be 5x's, some 10x's and so on. However, I believe that stability and the company's ability to be around in, let's say, 2 decades from now is very important. I'd much rather have a 5x from a stable company than a 10x from one that would go bankrupt if gold is getting to 1,300. Not to mention that if gold and interest rates keep going down, stable gold miners will be in an excellent position to buy the smaller ones. So let's begin with Barrick. I have an analysis just for them, so in case you want more you can check that one. Barrick is the second largest miner on the planet and can produce around 6 million gold ounces per year. They have a lot of tier 1 gold mines, which is basically the best type of mine you can have, and they also have some exposure to copper, which acts as a hedge since copper and gold are pretty much opposite. In the last year, Barrick's all-in sustaining cost went up to more than 1,350 per ounce, which is a lot more than the 1,200 they had a year ago. They expect the rest of the year to be a bit better because the first half was affected by maintenance works and shutdowns, which affected the production and the capex. This is something that we always have to keep in mind for any miner out there. You will never have a stable production when you have so many mines because there is always going to be some maintenance or flooding or repairs. They have a really good financial position with total liabilities of 13.8 billion and current assets of 7.4 billion, which is also how they decide what dividend to pay. A couple of years ago, Barrick announced a new dividend policy based on the amount of net cash that they have. Because of this, we know what the minimum and the maximum dividend can be unless there is a special dividend. In the worst case, the dividend would reach 40 cents per year, meaning around 2.5% from the current price, which is not terrible. The maximum, however, would reach around 6.25% from this price, but if we get to a lower price we can even see this at a yield on cost of 8% or even more. I have to say Barrick is not really the best dividend paying miner, but there is stability, high quality mines, good financials and so on, so of course there is kind of a premium. The current net cash position is below zero, meaning that the debt is higher, but we are only talking about a few hundred million. If the second half of the year is as they expect and if gold prices remain high, they will probably pay a high dividend for a longer time. Because they use the net cash position, this means that if we see a very good year, the dividends following it will be at or around the highest level possible for some time, which is another advantage of Barrick compared to companies that pay based on the profits. The second company I want to talk about is Newmont. They are now the largest gold mining company on the planet and have recently bought a pretty medium to actually big size competitor called Newcrest. On top of gold, they also produce copper, silver, zinc, lead and some other metals. Similar to Barrick, they can produce a free cash flow from around $500 million to 3 to 4 billion in very good years. This was before buying Newcrest, however, which was making around 400 million to 1.3 billion in good times. The all-in sustaining cost is incredibly high for various reasons, around 1,470. Of course, they expect the all-in sustaining cost to go down, the production to go up and so on, but we know how this industry is. They also pay a dividend with a yield of around 4.5% today, but they have a more variable policy than Barrick. They have a base of $1 per share plus a different amount based on the price of gold, with a minimum of $1 being paid at 1,400 per ounce. Newmont has current liabilities of 2.7 billion and total ones of 18.7 billion. The current assets sit at around 6.1 billion, so they should be fine in the short and medium term. Once again, keep in mind that this is going to be different once they integrate Newcrest. By the way, that company is actually surprisingly good, and you can see some numbers on the screen. The all-in sustaining cost is below 1,100, decent free cash flow, a really good net debt position. It's definitely going to be an improvement for Newmont, and it kinda makes sense why they paid so much for them. The next company in today's video is Franco-Nevada Corporation. This one is a gold royalty company, not a miner, which is a company that focuses on financing gold mining projects without actually doing the mining part. They also invest in silver, platinum grade metals, iron, oil, gas and more. An example is the recent acquisition they made in one of Barrick's projects for 75 million. In return, as long as gold is above 800 per ounce, they get 2.7% of the gold they produce after smelting costs and 0.54% of copper. So this is like you buy small pieces of mines all over the planet and they pay you based on what they produce. We can see how they have a smaller but somewhat more stable free cash flow and a much lower capex, which is generally a good thing. What's very attractive about this company is the fact that they have no debt. The current assets are worth around 1.5 billion and the total liabilities are only a bit below 230 million. This puts them in a great spot because in the future they can access more debt if needed, and the risk of such a company going bankrupt is almost zero. The issue with this stock is the price. After doubling in 2018 and overall having a very good performance since they spun off from Newmont, it barely moved from the current price, no matter how much money they made or where the price of gold went. To get an idea, they have the same market cap as Barrick but produce much less than them on average. The dividend is also very small, around 1%, and that's like a third of the average income, so you can't really expect them to pay much more. Maybe once we see lower interest rates, they can borrow and fund more projects, which would then unlock more growth, but this price for the company's current potential is simply not worth it in my opinion. And this is the case with many other gold royalty companies that are in a very similar spot today. Other than this, there isn't that much to say about this company. It's an even simpler business model than commodity producers, which is one of the easiest types of companies to analyze. The final company in today's video is Agnico Eagle Mines, a Canadian gold miner with operations in Canada, Mexico, Finland and Australia. With a market cap of around 20 billion, they are at a similar size as Barrick and the others, but they produce a lot less money, and that's after a record Q2. They produce around half of Barrick's annual production, but have a very attractive all-in sustaining cost of around 1,150 per ounce. Financially, they are doing fine. They have a lot of assets, they don't have that much debt, and the current assets are twice as much as the current liabilities. Over half of the total liabilities is in deferred income and mining taxes, so they are not bad at all. The dividend is also interesting with this company. As a gold miner, they have been paying a dividend every year since 1983, and instead of having it fluctuate based on the price of gold, it only went up since 2015. Currently, it has a yield of around 3.5% and it represents around 640 million per year. This is not sustainable at all, so a cut seems pretty likely relatively soon. A year ago, they also had a merger with Kirkland Lake Gold, which wasn't really the best time for an acquisition, but it's working fine so far. The problem with this one is once again the price. This company should be valued at like half of the current price in today's market, but if I get the chance to buy them around that much, I would consider adding a bit to my portfolio. I get that there is a premium for quality, but it's not really that justified. But there is also another aspect to consider. It isn't an attractive price for me as a value investor, but if Newmont paid 19.2 billion for Newcrest, who knows how much Barrick or someone else would pay for Agnico or any other miner. Newcrest was producing less than Agnico and it was bought for a similar valuation. At the end of the day, I still want a good margin of safety, but this together with gold going to something like 3, 4, 5,000 per ounce remains some very attractive potential opportunities. To finish, I want to mention that since every miner has higher all-in sustaining costs and they are most likely going to remain higher than in the past, we can expect both the theoretical bottom and the average in the price of gold to be higher in the future. I think it's very unlikely to see gold back at something like 1,200 per ounce for a long time, because it would lead to companies producing much less and thus lowering the supply, which can boost the price if the demand remains the same. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.